This is Siddharth Alwalia. Welcome to the 100x Entrepreneur Podcast. This episode is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Shripati Acharya, and Sanjay Swami. Prime is often the first institutional investor in category creating tech startups in fintech, SaaS, healthcare, and education, such as MyGate, Quizzes, MFine. To know more about Prime, visit primevp.in. Today I am with Rahul Chandra, founding partner of Unitary Helion Ventures. Rahul, welcome to the podcast.
Thanks, Siddharth. Thanks for inviting me. Great to be here.
Rahul, we'll also like to talk about, first start with your book, The Moonshot Game. How did you come upon the idea that, you need to write a book about venture capital, which is usually a not so well-known topic outside the startup circles?
Yeah, in fact, this is probably the first book which actually takes you through a inner journey and some of the thought process behind investments which are public in India. Obviously, this is the first book by a VC in India. What got me to writing it was, of course, so many years have gone by. I've been looking at investments which have either failed or have grown to becoming very large companies, very prominent companies in India. And I thought that as Indians, we share less than we need to. I think the learnings are growing exponentially, and the benefits can also be exponential if people start sharing their journeys more frequently. And I see that a lot in the West. And maybe there is a correlation between the progress and the speed of progress in the West because of this sharing that happens on a more regular basis. So one was certainly seen a lot in the last 15 years. And also one attempt that I wanted to make was to humanize the life of a VC. I think unfortunately we say no maybe 1,000 times in a year and yes maybe 20 times a year. So it's a pretty sad place to be, saying no to so many people who are doing good stuff. But in the process, I think there is less understanding of how a VC evaluates businesses, and when you actually talk to a VC, I think the point I wanted to bring out was they are probably as clueless as anybody else. It's not like they have a crystal ball. They're trying to decipher and learn with you, and also take a leap into the future along with you. So imagination that a founder is able to convey during that initial meeting, and what then that causes the VC to quantitatively convert that into an opportunity. I think some of those thinking patterns that evolved in my head is what I wanted to share.
Rahul, before diving into anything investing, let's talk about your journey, about growing up and how you landed your job in VC.
Sure, Siddharth. So yeah, it's been a while, but I think what really led to it is I was in Bombay, and I was working with an investment bank, and the time was 95. Markets were actually very slow, and I discovered this animal called private equity, because at that time there were very few sources of private money. And there were, of course, a few funds sitting in Singapore and maybe one or two in India at that time, which led me to then start exploring what private equity was all about. And I was, as a result of my job, also meeting some of the investors. A current chairman of Warburg, he was in India from Hong Kong looking at investments back then. He was looking at Asia. So things were really early. But what it did was to pique my interest in what was something so alien in India. Public markets were underdeveloped, and here was another very exciting investment path, which was to actually come into private companies. The journey from that point of curiosity then led me to actually approach a firm called Quantum, which was representing a US VC firm called Walden. Walden was the first VC firm to actually set up a India-focused fund along with Japanese investors, Nikko, $30 million fund investing $1 to $2 million in Indian companies back in 96. So this was when most people actually did not know what VC was. And a lot of the meeting went into just explaining that we are not here to give you a debt. We are people who will take equity risk, and as you can imagine, things were really, really early. When I think when I go back and look into my life and see, how I kind of made myself comfortable getting into something so uncharted back then, is probably my childhood, which was spent in Dehradun. It was a quaint town back then, and it was obviously, like for most of us, very secluded. Window to the world was through books and magazines. There was no TV or phones, and I think my theory is also that if you are forced to imagine, I think that really helps. It helps your power of thinking stuff, and because you're reading about it or you're hearing about it, and then you're creating it in your head. You're not getting fast food of actually seeing it play out. So the that seclusion is what I attribute to curiosity, which was I think very strong growing up in Dehradun about the rest of the world and what's happening. And I think what I followed is a path of of just wanting to know more about stuff which is more horizontal, and getting to know about the world. And I think the second thread I followed is again, when I look back, I've seen that as a pattern, which is there is a need to be very optimistic about things that have a very good chance of failing, and that sense of optimism, I think, goes back to to inherent qualities, to be able to believe in startups which are which have 99 ways to fail and one way to succeed, to be able to then come and invest capital in them. I think people need to have a very strong sense of optimism, and that also I trace back to things I picked up as a kid. So coming back to Walden, I think that was an interesting conversation I had with my boss back then, which was, hey, am I doing the right thing getting into VC? What is it all about? I've heard vaguely about Silicon Valley, and I have no idea what it will do or how it will play out in India. And we are talking 1996. Thankfully, my boss, who was based in Palo Alto in Silicon Valley, gave me good advice and say, you will not regret this. Because I was making a choice of moving from public investing to private investing. So 1996, I did take the plunge, and I've been investing in tech since back then.
It's been 25 years. Wow.
Yeah, I've seen a lot. 3 cycles. I think most people even ignore because those cycles were so small and insignificant. It's almost like India got a fever when the valley sneezed with the dot-com bust, and but there was a fledgling VC ecosystem back then. A lot of the names, actually a few of the names you hear now, were born back then. Some of them, interestingly, have chosen to become PE firms like Westbridge and Chris, but they did start originally as VC firms taking tech risk, and and a lot of firms, of course, did not survive. So yes, it's it's been a long journey, and obviously the world has changed, and like I was saying, there's just so much that has happened. I felt compelled to put it down in a book, so that was what that came out in the Moonshot game.
And how was the journey from 96 to 2006 before you started Helion?
So Siddharth, that journey actually was a very deliberate attempt to go to where it all started, right? I kind of made up my mind that VC is what I want to do in life. And it was becoming, every day it was becoming obvious that it's a lot of fun. And, when you're sitting in India, you've, you know that you're in a, distant offshore location where things are still very early. You do want to go and, actually put your feet in Silicon Valley where it all, happens. So 99, I actually moved with Walden to their Palo Alto office, and it was a big shock. right? So I was I was thinking I've kind of learned a lot in India about how VC is done and what companies should look like. And I get to Silicon Valley. Obviously, I expected a steep learning curve, but that was much steeper than I expected. Companies all around were, actually deep tech, because Valley is a lot about filling gaps, and it was very much the lower layers of the protocol, which is we're talking routers and and DSLAM equipment, and even components which where you're doing chips for just faster processing of data. So the right from the data layer to upwards, I think the Valley was at the forefront of building the equipment and the infrastructure that then led to the future effect of broadband and internet on the rest of the world. So I was there at that point when things were just being made faster and cheaper, so that internet just became more widely used. For example, one of the companies I was closely involved with was using satellite to drive broadband, and they were building the home equipment to receive broadband signal. And this was a theme across the board. They were chipsets that were going into these, which companies like Broadcom were building, which had a lot to do with how do you process faster data traffic. So there was certainly a construction happening in the Valley, which if you now look back, was the foundation layer for what then got done, which is broader and wider internet access, and people building what was called killer applications at that time to drive that usage. So chicken and egg. Why do we need fast broadband now? In 2020, we of course know that, but back then that was a fundamental question, which is why do we even need faster internet? Because we have our emails working fine. So thankfully that people didn't stay with that question for too long, and faster internet was built, and the next 15 years was all about running faster things on that. So 96 to 99 till 2006 I was in the Valley investing in companies there, and then 2006 I moved back to India as a co-founder of Helion, where the four of us, Sanjeev, Ashish, Kanwal, and myself, we had raised a $140 million fund, marking almost like the second start of building the VC ecosystem in India. I think Nexus came about a couple of months after us, Matrix in the following year, and it was Fund 1 for everyone in 2006 and 7.
So Rahul, what was starting up Helion like back in 2006, and what are some of the 100x companies that you have backed?
Yeah, I think 2006, again, just to put the context in place, was very different from now. The main difference was India was still struggling with what would drive wider adoption of the internet. There was this question of, laptops cost a lot. Will Indians be able to afford it? There was no smartphone in sight. And the chicken and egg of, broader connectivity was always playing on our minds. Everything we looked at had to have omni-channel. Call centers were the main customer acquisition engagement channels. And slowly and surely, I think the change was happening. But for 4 years until maybe 2010, it was absolutely not like a certain thing that there will be so much penetration of the internet. Things were growing very slowly. So the lens through which we are looking at companies in those 3-4 years in the beginning was very different, right? We are trying to anticipate a market which was not yet there. We want to be technology investors because we are coming from the Valley. Yet in India, the ways you can become a company that is, it's a mass company, is growing exponentially, those elements are not there. So it's a challenging time, and they're looking at missing is that vital element of how do you acquire customers and how do you take services to customers. So it's a big quandary for a VC because of course you want to invest in companies that will end up growing fast. So, we start taking bets, right? First bet we took was very promising company. Fundamentally, it made a lot of sense. It was called G Grahak, great entrepreneur, thinking product first, but in an ecosystem which was very hard to actually roll that product out to a wider audience. And just the sweat and effort that went into getting that product into people's hand was just sucking the energy out. It was costing us, it was taking time, and just hard to show traction, right? And back then, 1 million users just seemed like a lot of people, right? Unlike now, where you quickly run up to 2 to 3 million users, and internet helps just such rapid adoption. The business was simple. It was talking about how do you transact on smartphones. Like I said, the logic was very sound. People will adopt smartphones because they want to transact, and we were not successful because again, the idea was great, timing was wrong. I think that the team tried its best, but just didn't work out. And almost at the same time, we backed a company called Make My Trip, which was I think way ahead of competition even back then. Thankfully, it has retained that lead, and it was making itself widely available through an omni-channel. It was available at a neighborhood corner store. It could be a service that you could call in, and it was everywhere. I think people just prioritized it like a train ticket, and they were making effort to book their tickets online through Make My Trip. So that company, because of the the pain point it was solving, which was actually very universal, was able to grow at a very rapid pace. And the ecosystem, the friction in the ecosystem actually did not impact it as much as it impacted the other companies that we backed. So Make My Trip turned out to be a big winner, as we all know. And I think, again, one of the company we backed from that fund, again, not such a sexy business anymore, but almost the last pieces of India as an outsourcing center to the world, still made sense back then. I think in terms of choices, you had to really pick companies that could scale, and the real demand for corporate needs really came from outside India. It was not an Indian corporate that could help you build a company in India. So we invested very early on in a legal services company, LPOs as they were called back then. And again, this company was sitting in Gurgaon, delivering work around litigation in the US. And it was growing at a compounded average growth rate of 100-150%. And it grew like that for the next 5-6 years. So when you compare growth rates, a B2B company doing non-sexy outsourcing work was growing at rates which were, so right and so attractive for a VC in terms of generating returns. So things were obviously very different back then, Siddharth, and the turn really happened in 2011, we feel.
And what were the companies in the later stage of 2011, 2016 that Helion backed? Like, especially you take a call on.
Right. So, 2011, I think Flipkart was born. It was really a sign of the time. We were beginning to see more entrepreneurs who were building products that could be mobile first, or it could be, it was built for solving very specific consumer needs. Entrepreneurs were getting more, a rifle shot in their approach. And the companies we started seeing were the early versions of e-commerce companies in India, right? So if people remember, there was something called Big Shoe Bazaar, or what became Yebi, which was like a online fashion company. Spent a bit of time looking at that. There were a slew of payment companies even before Paytm became a payment company. It was just a recharge company. So the number of payment companies I would have seen back then begging for a use case was phenomenal. I think payment was a large vertical that had appeared in that time. And then I think in 11-12, we also looked at a company called Let's Buy, which was an online commerce company for purely consumer electronics. Again, the thesis was that everyone wants to buy a mobile phone. Let's Buy was, just going on that demand curve, and a lot of consumer brands did not have enough distribution in India to distribute consumer electronics. So companies like Let's Buy got funded at that time as well.
And through Let's Buy, you ended up having stake in Flipkart.
Yeah, that's right. I think the China e-commerce market was going through pain at that time. I think a lot of companies that had run up in value and excitement, there was suddenly that 3 to 6 months in China where everything crashed. Rounds were being done at 40-50% discount to the last one. And, like in 2001, the Valley sneeze gave India fever. I think in this case, the China sneeze gave India fever. So there was a lot of existential question that occurred in that time frame, which was how much capital does an e-commerce company eventually going to need? Is that kind of capital available in India? And should VCs take selective bets instead of investing in a lot of e-commerce companies? At Helion, we chose to go the vertical commerce path. We felt we had missed on the horizontal commerce opportunity. And we were backing companies which were specifically focused on fashion or consumer electronics. And what then became challenging was in this environment of realizing that the cash needed for e-commerce was something not available with Indian VCs. Tiger was just beginning to come in. I think they wrote their first check into, or in their e-commerce pursuit, they wrote their check into Flipkart. Things were still very early on and unproven that there'll be enough capital. So there were mortalities, or almost like a choice of which company is going to make through that first door, because only those companies which could access deep pockets were then making the cut beyond 2012-13.
And what made you, then, Helion is almost like the PayPal mafia of India, albeit a venture capital. Like, it led to,
multiple
VC firms, and
yeah.
all are doing very well in their respective sectors.
Absolutely.
What was the decision that, made, all the different partners start different firms?
Well, I guess it probably was a place which valued talent. I think it valued quality people, and it became a collection of, I guess, where
Top
people...
8 to 10 partners, right?
Yeah, well, we were 7 partners at peak. So the culture in the firm was, I guess, a very open discussion around most investment opportunities, where people were expected to participate in every opportunity that came along. Heavy on learning and on governance. I think as a VC firm, I had come from the Valley, and I had not seen the kind of governance in the Valley as we tried to build in Helion, between a partnership that was trying to be honest about what was really happening in the portfolio, making honest conclusions about companies that we already made investments and felt that we had made a mistake. Acknowledging that mistake when the follow-up rounds came, and then being in that way cognizant of the fact that yes, there is some capital needed to support companies, but then being very conscious that there are certain companies which are not going to make the cut and some that will. That was purely driven by a culture of answerability, and I think some of the other things we did was we pursued a founder-first culture as well. So we were one of the early firms to conduct surveys where the partners would get evaluated by founders. We would take feedback from founders who the partners would have dealt with and ask them, if the interaction was where they felt like they were heard, they were valued as founders. And at the end of the year, we actually knew how we had done in that year, right? Because we did not, like I said in the beginning, we, as a VC firm, we say 1,000 no's. It is not a popularity contest, yet we want to be a firm where people add value in a conversation. So I think the reason why there are so many firms that came out of Helion is really the kind of culture that we had, which valued honesty, transparency, and discussion. And even people who were associates and analysts today actually are in various firms and doing very well.
Rahul, you have observed founders, worked with them for the last 25 years. What would you say the traits of those founders who really break out or build 100x companies are from the rest of the founders, who try their best but, suddenly luck is not favoring or not able to make it?
So I think because your question is great and I want to answer it with something which resonates, I think my one word answer to that, Siddharth, would be transparency. And I think founders who follow an approach of transparency with their employees, with their co-founders, with their investors, I've seen that is a reflection of, just honesty and acknowledgement of whether the shit is hitting the ceiling or things are going great. But at any point in time, they keep a consistent standard of transparency. I think acknowledging a mess is a trait of a good founder, right? Because then people can help, they can ask for help, and where it is always, let's cover it up and, let's present a very, normal picture. Let's not take help from our investors. Let's not really call out the situation. That's when things start becoming harder to deal with. When, I think environment turns for every startup, right? It's a constant war that a founder undertakes every morning he goes to work. Because the environment completely changes. I think no day is ever similar for a founder. So for me, I think consistently what I've seen is that once you are funded and you're running a startup, I think it's very important to keep a high degree of transparency across employees, co-founders, and investors. Now, of course, there are other factors, like you said. The other pattern I've seen is for success, the most important thing I've seen is timing. Right? I think in the last 20 years, I've seen the same ideas coming in the heads of very smart people. And of course, the product looks different every time. But the problem they're trying to solve is quite similar. It's almost 3-4 years again and again. The world doesn't change as much as we think it does. Founders, have ideas which look very similar to what happened maybe 10 years back, 6 years back, 3 years back. What works at that point and, takes a company to the stratosphere is really that at that point, that idea just had everything going for it. For an idea to work, I think the timing is most important.
You mentioned about timing, right?
Yeah.
You were backers of Bigbasket from very early days, and there were a lot of grocery startups previous to to Bigbasket. How did you identify that's the right time to solve for example, in Bigbasket?
So Bigbasket actually was a business model where everyone remembers Webvan. Right? Webvan was a classic, colossal failure. And it was very embarrassing for VCs because, it just stuck that such a high profile company failed. So getting into online grocery actually came with that baggage that, there's only been disasters along the way, and it's very hard to make money because margins are so thin in grocery that, the businesses cannot be self-sustaining. And this was, still a time where gross margins and contribution margins were, actively being considered. So Bigbasket, I think there were 3 things. One was that the founding team had done 2 startups before. I think the kind of challenges in a hard business like grocery, we felt was best handled by a team which had been there, done that. Right. So the gray hair really helped in taking a problem, acknowledging again that it was a hard one, and then doing something about it. So we were assured to some extent by the experience of the founding team. Second is there were examples of companies that were breaking out, not in India but outside. There were companies that were going public in UK which were doing similar businesses. Of course, the density in London is totally different from a density in a bigger city in India. But we felt that there are ways to create margins in the grocery business. As you mature, there are certainly things that you can do to add to the margins in the business. And the third was, we felt that again, like true for everything else, the build out of formal sector is going to take its own sweet time, and there is an opportunity for a better service for people to start consuming grocery from, which was hassle free, convenient, and I think the modern nuclear families would tend to value time over going to the grocery market, choosing the right vegetables on a more regular basis. The value over time was increasing versus value of a discount or a better price. So we felt from a demographics perspective, it was certainly a big city phenomena. It was started in Bangalore. We could see patterns where people in Bangalore were beginning to order it more frequently. There was loyalty in the customer base. But these three factors, which was the experience of the founding team, the fact that over time we looked at businesses which had added to their margins, and the third was just the changing demographics of the customer.
You shared earlier in the podcast and also in your book that VCs are also humans and they are as cool as anybody else, which people think they are a different breed altogether.
Mm-hmm.
Yeah. What are the challenges or hardships you have faced as a VC which most of us don't know about?
Yeah, I think the VCs, unlike founders, are in this isolation chamber again, where there is transmission being received about the good news and the bad news that's happening to their portfolio. But then they're supposed to just make a call from that isolation cell. Right, so it's very frustrating to actually sit there and process bad information, and I think emotionally be ready to either suggest solutions or just digest it, because the benefit that a VC has is that when you look at 10-year cycles, from a seed to an IPO, your lens is looking at a much longer time frame than a founder's is. A founder's probably looking at the next financing or maybe the end of the year. So as VC, I've learned to discount disasters because I've seen so many. Right, so I think that's a helpful learning I've had. But amongst challenges, in my investments in some of the companies, which one of them was hit by a regulatory change, and that was an overnight disaster which actually took out most of the company, almost leaving it very close to fading away. In fact, most of its peers were swept by that big change, and the problem was that we had actually committed a large amount. So it was one of the biggest checks we had written, and just in one night, that company it was very clear that company is not going to return that money. Chances of recovering from that was very low. I took it quite badly, of course, because I had made a very strong case for going over and above what our normal check size was, taking an exposure which was I thought meaningful. So this came as a shock, and again, this was at a time when I was still seeing my early shocks, and it was very traumatizing. Right, so basically to see $10 million was a large check from a $140 million fund, and to see it just disappearing was very painful. Luckily, of course, and again to kind of give me that learning that time is very unpredictable. That company actually came back and had an IPO. So when I look back, of course, company was lucky and the founder was amazing at continuing to work at it. But just at that point, it felt like the world had ended.
You're talking about Make My Trip?
No. Make My Trip never came. Actually, Make My Trip has had a very smooth journey, partly because of the way the company was run, and of course, it kept its leadership position. But this is a company in the microfinance space, so over time, of course, it has, like I said, it's fully recovered. It's got a very strong balance sheet, and now it's a public company. So I'm very thankful for how that company was able to come out. And we've been able to make money on that, which justified all the pain.
So VCs also have sleepless nights as founders have.
Yeah, sometimes we get calls at midnight as well, for all kinds of reasons from founders. So I think it's an interesting exercise where I am on a vacation maybe in December, nobody else is around, and I get a call at 11:30 in the night. I'm speaking for the next 2 hours with the founder. A lot of it is just sharing in the situation. Of course, there are situations where it is war room, where the board gets together, and it's always good to have a VC who has seen enough disaster and challenges in their VC careers to be with you in these war room situations. But you're there basically staring at something which can be a big wall in front of the company, and you're trying to either trying to tell the founder the best course of action according to your past experiences, or looking for what you can bring about in terms of maybe a financing is gone wrong last minute, the company has 2 months of cash left, and it's unlikely that there will be a round happening anytime soon, and then you have to take the consensus decisions from your firm. You need to make sure that you are very sure that you're recommending some more capital to come in at that point, and this is a company you really believe in, because there is no validation happening from outside, right? And those are tough moments, because that's really when, as a VC, you want to be sure that if there was no other dollar coming in from the rest of the world, will you still put your last dollar in that company? And that kind of belief, I think, in company is very important for VCs to build, right? I think a lot of us, I have done it in the past, where I've looked for external validation from other investors coming in. I mean, a big valuation coming from a third party is always solid validation. But, it doesn't happen all the time. It could be where, the company's run out of cash, but you still believe that company has the mettle to actually go forward. So those are things where I think VCs have to take very tough calls.
And what do you think, evaluating back, thinking back, your strengths and weaknesses unique to you as a VC have been?
I started off as someone who's not come from an operating background. So I've spent so much time, I think, looking at startups, spending time with founders, and I value my time spent in the valley, where I really understood technology better than if I had been an operator. So I've come to VC with a handicap, which was not to be an operator. But, so that question was actually a very common question in the valley, which is what makes a good VC? Is it an operator or is it a non-operator? And I think the world has enough examples of both. At the end of the day, I think the role of a VC is the full stop button for even an operator to stop thinking like an operator. And as long as you have the empathy to actually think like a founder, you can overcome any handicap. And I think the time you spend with founders understanding real situations, right? Not one step removed from an entrepreneur, which is usually going to lead to giving advice which is so off the charts that most founders should actually ignore it. Keeping the context and keeping the reality in mind and being able to give usable advice to the founder, I think that is the end test for VC. And for that, you have to keep things very real, right? You have to be actually factoring in a lot of your learnings from the past, right? And I think experience and time spent, and I value again the time I've had with so many founders and startups, where I think the strength is I'm able to now process a lot of my past learnings And it leads to a mental framework which is always flexible, right? And for me, the uh, constant reminder is that every situation is different, and I need to then apply what I have learned in a more synthesized manner versus just giving canned advice. I think the world is always striving for efficiency, and giving standard canned advice is very time efficient, but it's also sometimes not usable. So I think from a ability to look at the past 15 years of situations, war rooms, fundings going bad, or pressing the pedal on growth, those are things which are sitting in my head, and being able to make the right combination of those learnings and giving the most relevant advice to founders at that time is what I think I'm able to do better now. Last 10 years I've spent phenomenal amount of time with great founders. Obviously this is you have to be a sponge. Like I said in the beginning, curiosity is really key for a VC to do better, and I think that curiosity is what leads you to absorb and what are the strengths from other founders and pass it on to to the others. So I think the strength that is now with me really is this long experience of seeing a lot and then being able to still remain flexible for that situation versus becoming this canned advice giver, which would be very impractical advice in most cases.
And what do you think on the weaknesses part?
Weakness part, I think the part which always is intriguing and hard for me to judge. In consumer companies, it's very hard to tell if there is a real traction or not. And in India especially, one thing I've come to rely on, and I think still working on, is how to use data to be able to predict better, or to actually judge better if there is some traction that is going to stick, or is it just temporary. So the path I'm on really is to fix that using some data to be able to understand whether the product market fit is happening or not. And I think the external help or the indicators that help me, I'm trying to build those, which is to understand whether talking to consumers will help, or for that product, taking feedback surveys, will that help, and and to rely on the product thinking of the CEO. I think that would be something that would also lead me to make better judgment on whether that product is going to evolve with changing consumer needs. So I think that that vagueness in backing consumer startups, unlike a B2B startup where you absolutely get a fair idea from an enterprise customer of the the need and value for that product. I think it's very hard to get feedback from 10,000 users, 20,000 users. So I think there is a lot of judgment in consumer products that needs to get backed. And I also have another handicap, which is I like to spend time with the founders before I invest. So I'm not very good at taking snap judgments with one meeting. I generally tend to spend several meetings before I get inside the mind of a founder to start extrapolating what would be the choices that the founder would make in different situations. Because it is such a long journey, Siddharth, it's very important to actually spend that time with the founding group, understanding founder dynamics, or the transparency levels we talked about, or the the product thinking that the founder brings to the table. I think those are some things I prefer doing. Obviously, given pressure situations, if there is a very compelling deal and there is pressure, then I would react fast. But given a choice, I would really like to spend a decent amount of time with the founders to understand how they want to build this out.
Rahul, let's come on to your journey of Unitary Helion. What is the thesis of starting this fund? What's the fund size, and how much is the ticket you are investing in each company?
Yes, so looking forward actually to deploying from this new vehicle, Unitary, and the thesis has been put together based on past experience and learnings. Right? So I think the key trigger was that in India, the largest markets are those that belong to middle India, and it's very difficult to build a product for top tier India and then recustomize it for middle India, because the customer profile is significantly different. So we have seen scale actually get stalled because either you run out of the market because you're catering to a small segment of the population in the metros, and that's the user consumer who's been oversold. There are few of them, and we believe you cannot build scale companies with consumer bases which are small. In the past, I've invested in companies that have gone to middle India by design, not by accident, but by design. And I've seen the scale and the gap that they're filling. It's where actually markets are so large that you do not need to spend significant amount of money to acquire customers. There is so much unfulfilled need that you could be along with 5 other companies and you would still not be running into each other. The markets are that large. Understanding that middle India consumer has a very different approach to consuming products and services. They are on a cycle of adoption, which is very different, where they go from the initial phone use to consuming it for information and entertainment, and then moving on to commerce, how and when they will use that. And this thesis then led us to what is the largest market share of middle India, and those 4 areas then became our core areas for the thesis, and those are financial services, healthcare, mobility, and agri and food. So we want to concentrate on these 4 areas. $2 to $4 million is the first check size that we will write. We have invested in 2 companies which reflect this thesis, and we continue to do more of this. But it is, Siddharth, of course, very exciting because you have a thesis which is really a framework, and then when you start seeing companies that demonstrate that basic idea, you see the expanse of the type of solutions that can come into this thesis. So we are excited because we're actually finding lots of quality startups that are going after this opportunity as well. So we are excited. We have our hands full right now. We are excited to make more investments in the next 3 to 6 months, and hopefully in a couple of months we'll be able to share more of what we have done and more about the thesis.
So with the current fund, you will be investing in 10 to 15 companies, let's say by 2021?
Yeah, that's about right. So our average pace would be 6 to 7 companies a year. And we have done 2, but our plan is that in the next 3 years, we should be at 18 to 20. This is not counting any seed investments that we might make. These are actually Series A investments. So we could have a slightly higher number, but yes, the pace should be about 6 to 7 a year.
And currently you have seen like many cycles of the founders, come and go by. What is the quality of the founders in 2019-20, which you are bullish on, still starting, almost your 3rd journey in venture capital?
Calm, composed, and ambitious. I think these are the 3 words I would use to describe the founder of 2019. I think the ambition part, of course, is consistent. Of course, the number has grown. But in terms of co-founder dynamics, I think people who have seen the chemistry not work out are being, are more careful about who they do their startups with, who they want to be partners with on the long journey. So we are seeing co-founding teams come together with more thought. We are seeing the ambition leading to markets outside India. We are no longer restricted to thinking of this as a purely Indian business where the Indian expectation and constraints exist. So people are going to US markets much sooner. Of course, the composure of being able to maneuver startups, and raise capital faster. I think that is certainly in play, because the sources of capital have changed, right? If I again go back to 2006 to now, the first check would come from a VC in 2006. Now it could come from a family office or an individual or a group of angels. So getting the first check is not as hard, and many more people are now getting that first check. So there is certainly a broader community that has happened of funded startups with some capital from somewhere. So the other aspect we are seeing is that there is a lot of knowledge sharing, not just about which VC is interested in what area, which is the best way to raise your Series A, but also learnings about failures. Communities are helping. The knowledge is getting shared amongst different groups, so they're coming with a fairly good sense of what mistakes not to make. So I think my expectation is that the time to a Series B is shrinking, from what it used to be, because the execution is superior, because people are making fewer mistakes and doing more right things, in shorter time frames. So this is, I think, a natural evolution where ecosystems develop on maturity. As more and more happens, I think people just become more aware of what to do. All of them also are coming from experiences at other startups. So I think that makes a ton of difference. Working in companies that are high growth, they just come with a lot of momentum or a sense of how quickly this journey has to be undertaken. So I think the 2009 breed of entrepreneurs is in a very good place with the right set of learnings and sharing of information, and also, of course, capital that is far more democratically available than it used to be.
Thank you so much, Rahul. Ending on a lighter note, you look like 25, 30-year-old, really, except a few gray hairs. What's the secret of your health been?
Thanks, Siddharth. I'm sure it's it's changing. Yesterday, somebody I met said, "Oh, I thought you look very young in pictures, but you're not as young as you look." But no secrets. I think it's health-wise, I would advise everyone to actually avoid sugars, processed food, and I see younger India actually being very careless about what they eat. Wherever I go, food courts and where I can see a lot of people eating, I think there is most of the stuff I cannot eat because it is so processed or has so much sugar. So I worry about finding food for myself, but my general avoidance is whatever is processed. And I think the rest is what I said earlier, which is how much stress do you take from each disaster situation. Keeping your sense of optimism high, I think knowing that there is a light at the end of the tunnel, companies will survive, businesses will do well, things will turn for the better. I think that sense of optimism keeps everyone positive, keeps me positive, and I think that sense of positivity is very energizing. Yeah, so I hope you can say the same thing in the next few years as well, and I hope I keep the young look going.
Wonderful, Rahul. Thank you so much for being on the 100x Entrepreneur podcast. Grateful to have you.
Thanks so much for that. Great to be here.